Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about some updates for Venture Global, ticker symbol VG, and I'm going to be going through the most recently announced increased production capacity at the Plaquemines and the CP2 facilities. I'm going to talk through a little bit of LNG market forecast analysis that some companies have put out. And then I'm going to try to present an updated way to view the financials of the company and kind of the valuation there. I know in the past I've done some DCF models, and I think that tends to be a bit much for folks, and it's a lot for me to go over in the video. I just feel like I'm talking all the details. I think I have a slightly better way to present that. I'm going to try to go through that today. Before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Venture Global, so this video should be for your entertainment purposes only, because I could be wrong about everything that I say in this video, and you need to do your own research before making any investment decisions. Alright, with all that being said, let me also add one more note, and that is I've got some comments recently on my videos that my sound has been bad. I think my setup was not using the actual proper microphone that I have. I actually do have a real microphone. It's not just a built-in thing. Oops, I just moved the camera. And so I think I have this configured properly. Please let me know if the sound is better or if it's still bad. Hopefully this will be better for y'all today, and then we won't have to discuss it anymore. All right, so for Venture... no, Dustin is my financial advisor. No, I am not. I think Matt is highly qualified to make his own decisions for himself. Anyways, hi Matt, thanks for hopping on the stream. So Venture Global, the biggest announcement that was recently made, this was, I guess not really announced by the company, I don't think, but they had the filings with the government, and this is I don't know really what to describe it as, but they basically said, hey, we think we can produce a lot more LNG from the Plaquemines facility and the CP2 facility that the existing facilities we have. Hey, thanks everybody for hopping on the stream. I'm looking at Dustin's Boulevard. That made me laugh. I saw that yesterday, or was it today? I don't remember. Somewhere on Twitter there. If you're not following me on Twitter, I have been trying to post a little bit more on there. It's at Dustin's Dollars. Anyways, back to the actual content. So they filed this, and they filed one of these documents for the Plaquemines facility and an additional document for the CP2 facility. Now, as far as I understand it, the design of these two facilities is pretty similar. I don't know if they're exactly the same, but that's, the capacity is the same, and a lot of what some of the aspects that, as I understand it, are similar between the two facilities. And they filed this recently, and hats off to, I think, I give credit to Venture Global Deep Dive, I believe is where I originally saw this on Twitter. It's a great follow if you're interested in the company. But they filed this and said, hey, we believe under optimal conditions that we can increase our peak production capacity from 27.2 MTPA to 35 MTPA of LNG. And they said that's, in BCF, that's from about 1,400 BCF per year to just shy of 1,900 BCF per year. So that is huge, because they go through it in this whole document. It's 27 pages long, but somewhere it should say, yeah, it's right here, that the requested increase in peak liquefaction does not involve the construction of any new facilities. And I skimmed through this document, and they basically said, two things. Number one, that the equipment is, depending on the ambient temperature that's outside, they're able to produce more than what they expected, and that they've improved some of their processes and controls of the equipment, and again, that they think they can produce up to 35 MTPA per year in peak conditions. So I think that is massive. That's incredible from this company, right? Like, that's almost the entire Calcasieu Pass facility. That's another 8 MTPA. The Calcasieu Pass is 10 MTPA at nameplate, for basically no additional cost to them, right, other than the cost of the feed gas and operation, the actual liquefaction of the facility and the power and such. But that is a humongous increase to the value of the company that is really not reflected by the recent stocks action. And they filed one of these both for the Plaquemines facility and for the CP2 facility. Obviously, the CP2 facility is still under construction. It isn't producing anything, but the Plaquemines facility is already basically at this 27.2 MTPA rate. And so that actually gives me a lot of confidence that Venture Global will be able to increase this pretty significantly and will be able to actually get above the 27.2 because they're already there. And if they're already there and then they're filing this, this is just filed in December to say, hey, we believe we can actually produce more. That is pretty awesome for the company. So that I think is the absolute biggest development. The other one, and I posted this on Twitter. Oh, I don't have it open. Let me get the right tab open here. Give me one moment. Is that so in December they recently closed some new notes of the notes that were borrowed against the Plaquemines facility, and so they closed $3 billion already in December. These are at lower interest rates than what they're currently paying. I think their debt on the Plaquemines facility today is between 6.5 and 7.75%, and so they issued 1.75 billion at 6.125%, and then 1.25 billion at 6.5%. And so these notes are due in 2030, 2034, respectively. And so this will lower their interest expense per year, assuming that they pay it off some of their higher, the higher rate debt that they still have outstanding for the Plaquemines facility by about, I want to say, $37 million per year. But the other even bigger news was, and if I can pull this one up, I meant to have these already up, sorry about that, is that the notes that are use the Plaquemines facility as their collateral, right? That project level debt for the Plaquemines facility was recently rated as BB plus by S&P Global Ratings, and this is pretty significant because, as I mentioned, the current rates that they're paying, other than the one that they just were able to issue at 6.125%, the rates that they're paying are 6.5% all the way up to 7.75% for the Plaquemines notes, and with this, they ought to be able to, I think BB plus debt is probably somewhere around 5.5%, and so that's basically 1 to 2 percentage point, or I should say 100, 200 basis points that they can reduce their interest rate that they're paying on the Plaquemines facility by, and so that's a pretty significant. If we looked at that, in addition to the $37 million that they're saving just from these notes that they just issued, the $3 billion of notes, they could probably reduce it an incremental $138 million per year just in savings on the interest per year. And so that's, pretty significant. And I think the Calcasieu Pass notes, I believe, are rated even slightly better. And so if they could get the Plaquemines notes even re-rated after it gets up and running, full commercial operations, and they basically have some of that cash flow more or less locked in, and they're actually delivering LNG under those contracts, they can probably get that to be slightly even better rating, and maybe get it close to, at today's rates, like a 5% interest rate for those Plaquemines notes. And so that, altogether versus, Q3 to if they were able to get everything refinanced at 5%, that would be $250 million per year in incremental cash flow to, the Plaquemines, and then obviously to, Venture Global themselves. And I think that would be fantastic. And then this is, if I look to the future, and this gets to, sort of my closing statement today in terms of why there's kind of a bull case for Venture Global, they have a lot of debt today. But, as they incrementally get this, get the facilities up and running and get their, long-term SPAs and the long-term cash flows kind of locked in, and they get better ratings, I believe they're going to be able to refinance and lower the interest expense, over time pretty significantly without even reducing their debt level, just because, they are going to be viewed as more creditworthy. And, all the notes that I talked about today are for the actual Plaquemines project level debt. But if you look at the corporate level debt at the Venture Global level, that is rated, I don't know, sorry, I'm not sure what it's rated, but the interest rates that they're paying are, 8%, 9%, somewhere in that vicinity. And so if they themselves can get rated something like a BB rating, and they can drop those down to 5.5%, even 6%, that would be a significant savings for the company themselves. They could be saving. Sorry, I'm just looking real quick at their actual interest payments. I think right now they pay somewhere on the over $1 billion a year. Let's say 1.2 to 1.5. Sorry, I'm just very, very quickly eyeballing, some of my notes here. I should have prepared. I apologize. But, if they were able to cut that interest rate down, they could be saving a couple $100 million per year as well, just from the actual Venture Global level debt itself. And so hopefully that makes sense. They have debt at different levels of the corporate structure, and the venture global debt is the has the highest interest rates, and so over time, that would have the largest impact if they were able to get those notes rated at a sort of a BB rating or something in that vicinity, and then lower that interest rate. So that was a pretty big thing to me. It's sort of like the first domino as I see, looking into the future. There should be a long runway of increasing credit worthiness for this company. One other thing I wanted to go through, as I mentioned, was some LNG market, I want to say forecast, projections, analysis, whatever you want to call it. So we had two of them. One of them was this article that I found from Argus Media, and you can read through it here, but basically they talk through, and their conclusion here is that long term, and maybe I can zoom this in so you can see this a little bit better. Oh, that was maybe too much. There we go. Long term, they believe that the effectively fixed fee equivalent from SPAs, that the price of LNG, the spreads between TTF or JKM and the U.S. gas, is going to compress down to $2.50 in the long term. And long term here, they're at least looking out into the winter between 2030 and 2031, and they've got their underlying math here. The deep blue bars here are 115% of Henry Hub plus the shipping costs, and then they have they show you where is it $2 and then $2.50, etc. for these different liquefaction fees, sort of as an equivalent of what you would be paying under a long-term sales and purchase agreement. And I believe that the orange line here is kind of what they're viewing and what their forecast is. And so they say, hey, we think this is going to get to roughly a $2.50 equivalent, and that's pretty good for the long term, right? To be able to have this, when you view it in the context of a lot of the narrative recently has been there's going to be this supply glut. And that brings me over to an alternative forecast. This alternative forecast, which goes through sort of the same time period, was from Goldman Sachs. And I tweeted this out when I saw it. Goldman Sachs is actually forecasting spreads to compress a ton more. Sorry, I can't pronounce the name. Akshatrastogi. Apologies for, I'm sure, butchering that really horribly. Thanks for hopping on the stream. Anyways, the Goldman Sachs forecast, they have, maybe I can zoom this in even more. That might be small for y'all to see. That's about as good as I can probably do without it cutting it off. But they have this dashed blue line here. It's fine. Thank you. I apologize for mispronouncing, I'm sure. They have this dashed blue line which shows forward TTF, and they don't talk about JKM. They only talk about TTF here. So, but at least you wouldn't expect that the gas is going to be. But I guess every region is different, so I guess I won't make a particular statement on that. But in terms of the U.S. natural gas price here, Henry Hub in the dashed red line, that is their, I think those are futures. That is realized. Sorry, that's what Goldman Sachs is projecting. And then the dashed blue line is what Goldman Sachs is projecting for TTF prices. And so you can see 2026, there's still quite a spread between Henry Hub here in red and TTF in blue. Then it compresses drastically in 2027, but there's still a spread. And then in 2028, they think the spread is going to disappear for part of the year and then be very compressed throughout the rest of the year, right? That's a much smaller spread here, as you're seeing, versus this is a huge wide spread. It's like $5, whereas here they think this is going to be more like maybe $2, let's say, just eyeballing it here. And then they think for some months of the year it's even going to go basically flat, where there is no spread, and to where actually liquefying and exporting would not be profitable. It would be unprofitable. Not even just would it be flat, it would be you'd be losing money to liquefy and ship to Europe. And they actually think this is going to be, if you read through their explanation, that they think that's going to happen because they think things are going to sort of get to that point of being just barely uneconomical, and then once that becomes the case, that is going to sort of have this domino effect where the long-term sales and purchase agreements that folks have signed with U.S. LNG producers such as Venture Global, they are obligated to pay the fees, but they're not necessarily obligated to take the LNG, right? And so the point here is that if some of those importers in Europe say, you know what, I can actually get the gas cheaper here in Europe, or cheaper from some other, LNG source, I guess, um, that they would actually not even take the LNG from their counterparty in the United States. They would just pay the fee, and no LNG would have to trade hands. Venture Global, or whoever the actual LNG exporter in the United States, would still have to pay, or sorry, they would still have to, they would still receive the money that, I apologize, they wouldn't be paying. They would be receiving the money here from the actual customer, from the importer in Europe, but that they wouldn't have to liquefy anything. And so they believe that would sort of cause a domino effect where that's a lot of excess capacity, because even the capacity that exists and is typically tied up by these long-term sales and purchase agreements would be available to export to any potential buyer that wants to buy at even, 1 cent of profit above, sort of break even, right? And who knows what companies will actually do. I'm sure there's probably some minimum threshold of profit that they're going to want to make, but each company is going to be slightly different in terms of where is their break even, what amount of spread are they willing to accept. And so Goldman Sachs' point here is the spread is going to compress to basically, break even, to where Henry Hub and TTF, there's going to be no arbitrage here, and for in 2028 and 2029. Longer term, in 2030 and beyond, they do think that, kind of because of that effect, where the spreads might really, really compress, and the future profitability in the long term might be a little bit, or at least the medium term, let's say, might be in question. But then that's going to sort of have the inverse effect on the LNG industry, where there's going to be very, very little new capacity brought online, because if you're looking at the spreads and you say it's not even profitable, let alone like that, there's no profit to be made parts of the year and then minimal profit the rest of the year. That's going to be really hard to justify all of the investment that is needed to build and bring up one of these terminals. And so Goldman Sachs argues in this piece that, or in this report, they argue that that is going to then mean that not very much new capacity comes online in terms of liquefaction, and then that might give some time for demand to grow and for importers to start to increase their appetite for LNG at those prices, and then kind of stabilize out in the longer term, where longer term here is starting in the 2030s and beyond. And that's a whole lot to say here, and it's a bunch of speculation on Goldman Sachs' part. I think I've been posting a lot, as I mentioned, on my Twitter, of LNG market news, and I think there's a number of signs that there are incremental demand that's going to grow. But again, there's a lot of factors here, and who knows? It's really hard to say. One of the things that I do want to talk about with Venture Global when we get to it is, even if these spreads compress, that doesn't mean that Venture Global, or any of the U.S. LNG exporters, are going to actually not make any money, go bankrupt. What this means is that uncontracted cargoes would not be profitable. Most, or all of the U.S. LNG exporters do have long-term, meaning like 15 or 20-year sales and purchase agreements with folks to purchase the gas at a fixed fee above Henry Hub gas prices, right? And so the point is that profitability on those uncontracted cargoes is going to be very, very low, maybe negligible, but that they still are going to have some base level of revenue that they can revenue, and let's say gross profit that they'll be able to bring in through those long-term sales and purchase agreements. So that is sort of a look at some of the LNG market analysis that I've seen so far, and I'll continue to share that as more things come out. I might try to do a little bit of sort of vetting this and looking at supply and demand growth on my own, but it's a very, very complex topic. As sort of a non-industry expert, it's kind of hard to do that myself. All right, I do see. Can you post a link of this report? I can post it. I can post it easily after I get off of here. But if you just search for Goldman Sachs, this is the name of the report. It's publicly available. If you just search for Goldman Sachs 2026 Outlook, Commodity Outlook, you ought to be able to find it really, really quickly. Probably before I'm able to finish this video. But I will post it. I'll put it in the description of the video once I'm off of the video. It's hard to change it midstream. A little bit tied up trying to actually keep talking. Sorry, I do see a couple comments here. So In my view, players who are entering and increasing the capacity quickly have an advantage since they will be locked in the SPAs before the glut hits. 100%. Actually, was going to get into that, but yeah, you took the words right out of my mouth, right? And I think this is a massive advantage for existing players, right? Because Venture Global, Next Decade, Chenier, all these folks who already have contracts on the books, they've locked in this capacity, and they have these facilities where they can expand. And even if they wanted to, they could sell more sales and purchase agreements against some of their existing facilities, right? Especially, it's a little bit dicey for, let's say, Venture Global to have to be selling above their nameplate capacity. But I think if they believe that they're able to produce 27, maybe even 35 MTPA from like the Plaquemines facility, but the nameplate is only 20, they could consider contracting some of that. They do have some uncontracted capacity. I think for Plaquemines they have like a tiny bit, like maybe zero point 0.3 MTPA, and then at CP2 I believe they have 1.5 roughly that is uncontracted. So there is a little bit of nameplate capacity uncontracted there. But yes, I think they have this. It's been a major advantage, and I would go even so far as to say it's not even just the advantage that they've locked in some of these SPAs before the glut hits. Because the glut, I believe, even if you look at the Goldman forecast, which is the most bearish I've seen, where they think the arbitrage is going to go away completely, they think this is going to happen in 2028, 2029, and then things will stabilize again in 2030. So if you have a long-term view, right, if you're looking a decade out, this glut is not destroying LNG forever. It's not like, okay, we're going to have more LNG than we're ever going to need. These companies are, going to zero. They're just saying, for a couple years, there's not going to be any opportunity. And then, again, sort of it's a cycle where there's lower opportunity, so there's lower investment, and then no one actually, or very few people are able to justify the investment to increase and build more capacity. And so because of that, then there is, less of a glut in the future, right? But in the interim, the companies that are already up and running, like VG, get to capitalize on these massive spreads that they have. Even if the spreads later on do compress, they're able to pay off a lot of that initial capex, that initial debt, while the prices are high, right? And so they get a much higher, let's say, return on their investment because they get to front load the benefits of having these massive spreads, in 2026 and 2027. So, sorry, there's a lot more comments. I'm going to try to get through them real quick. If Goldman Sachs is correct, sorry, this is from the Duckhammer, then it will hurt VG a bit more since they sell on spot a lot more than their competitors. Yes, absolutely, right? And so that is totally true. Where Venture Global is, they have probably, if you count in Plaquemines, for CP2, most of that capacity is contracted, right? I think it's 10 MTPA nameplate facility. They actually produced just slightly over 10 last time, but I think even their long-term, I guess their long-term SPAs, I think, are 8.5 MTPA, and then they have an incremental 1.5 MTPA to contract that full 10 under shorter-term SPAs. I think it's 3 years and then 5 years for the two SPAs that they have that are short-term under that. But for the Plaquemines, right, it's a 20 MTPA facility, and at peak they can produce, and they're already producing at peak 27.2 MTPA. So that's roughly 30-35% of that particular facility that is uncontracted. And I think they did sign some sort of an SPA for that was sort of like variable quantity, at least for the short term. But yes, long term, they don't have these long-term SPAs, and so that is going to hurt them a lot more in these time frames if the arbitrage goes away, right? Because those cargoes are just they're not going to produce that LNG because it's not going to be economical. So, all right, let's see. The Duckhammer also says, but they also can take advantage of the spread until then. Yep, absolutely. Totally on the same page here. And Kevin Hawthorne says, good afternoon from Lakeland, Florida. Good afternoon. All right, so moving on to, I think, what I believe is going to be, well, before I go into my actual view of sort of better way to view the company, I did pull the most recent futures prices for the next 3 years at least. and I calculated a sort of what I call a fixed fee LNG, fixed fee equivalent. And so this is the formula that I used here. I looked at all the Henry Hub prices and the TTF and the JKM, and I took the maximum between TTF and JKM. And maybe that's a bad idea. Maybe I should just use TTF. Um, but assume these excess capacity, the uncontracted cargoes, they can go either one. And then I took the Henry Hub price multiplied by 115% to account for the incremental gas that they'll need to actually perform the liquefaction. And then I added on $1.20 per MMBTU fee, and that covers shipping and regasification for Europe, and then for it is meant to basically cover shipping to Asia if they have to go there, right? Because I think Asian JKM prices, I believe, are quoted in terms of actual LNG, whereas a TTF is gas, so they have to go through the regasification process. But on the flip side, the trip from the U.S. Gulf Coast to Europe is less, so it costs less to ship there versus going all the way over to the Asian countries. So it roughly balances out. And again, that's not perfect, but that's kind of how I calculate it here. And so if I look across the next 3 years, the way that I look at it using futures data, again, this is not the same level of analysis that I'm sure Goldman Sachs did when they're looking at demand and supply and all that sort of stuff. So again, they've gone through a much more rigorous and detailed process than just looking at futures prices. But on the flip side, I also think futures prices means somebody somewhere actually priced that amount of energy at a particular price. Right? They actually put money down on these futures contracts. The volume might be low, so maybe it's not really that meaningful, but somebody at least did pay for these things at that price. Anyways, when I look at the next 3 years, I do see the spreads, in 2026, they are pretty wide, sort of as Goldman Sachs said. They are, $4, even short term maybe $5, $4, somewhere in that vicinity. It does continually go down. You can see the general trend here. The slope is going downwards here, and it will go down to let's say about $3 by the end of the next 3 years. That's at least what the current futures market is saying, and that is roughly consistent, with this analysis here from the Argus Media that said, we think it's going to converge down to $2.50. Ray says, I think he'll get a white Lambo. I hope it works out for you, and I hope you're able to get the Lambo from all your investments. Sorry, I went back to the wrong tab. But if I look at these spreads, I can see that, at least for the next 3 years, using futures pricing, it does look like this is going to stay at or above $3. Even if things compress a bit, they go down to 250. That still provides a healthy enough margin for Venture Global and general U.S. LNG exporters to make a healthy profit here. So that I think is good, and that gets me to what I wanted to go through today, and that is I tried to look at I tried to think of a different way to show some of the company's financials and the valuation and sort of forward projections. It's not my full DCF. It might be a little bit easier for folks to understand and take a look at. And I landed on making these waterfall charts. And so let me zoom in just a bit. I'm gonna go through a couple different charts here that I have. They're all very, very similar. I have some charts for Calcasieu Pass for that's one facility. I have a chart for the Plaquemines facility. Excuse me, and then I also have one for Venture Global overall, and so I'm going to go through them in that order, and probably spend most time at the end. And then at the end, I will get down to like a rough valuation model for the company that is uses this as the input basically. But I don't know how to make them actually show the full text here, so I apologize for that. Every single one of these is going to be cut off. They're all elided, and the Google Sheets, I just couldn't figure out how to make it work. But I will walk through these real quick, and then every chart after this is basically the same. So when we look at this, I don't know why it's showing this first line item. Forget about that. This thing doesn't always work properly. The waterfall charts are weird. But I have the green bars, which show sort of money coming in the door, and then the red bars will show expenses, money going out the door. So we have the Henry Hub, and then plus an additional 15% for the fee on the long-term sales and purchase agreements. And then we have on top of that, the fixed liquefaction fee, right? And so for the Calcasieu project, I think their fixed fees are in the $1.80 range. If this is using actual Q3 numbers, and when I divide it out, it looked like this was $1.76 per MMBTU. when you multiply that out, these numbers here are in millions, and so you can see they actually brought in from that portion of the SPAs that is for the Henry Hub plus 15%. They brought in $469.5 million. Then they brought in $234.1 million from that incremental fixed fee that they get for the contracts. Then there's also this line item for other revenue. This was $7.4 million. I don't actually know what that is. I couldn't find a description, but I included it in here because it is real cash apparently that they're getting. Then they have their expenses. They have to buy the feed gas. They have to have the additional gas, basically, that they this is their incremental cost of sales is really how it's reported. But this is basically, as far as I understand it, the incremental gas that they use to pay for to generate the power when they're doing liquefaction, and some labor there. Then they also have their operating expense and their maintenance. And that's another $82 million here. Subtract off their G&A that is specifically for the Calcasieu project. This is not the overall company's G&A. This is the G&A that's specifically for the Calcasieu project. Then they also have the interest that they have from all of the debt that is specifically the project level debt against the Calcasieu project. Then when I add all these up and subtract off those, you do get to sort of a rough free cash flow number of $88.9 million per year. Sorry, that's per quarter, excuse me, because these are the actual Q3 numbers. And then if you look at that on an MMBTU basis, that's like 67 cents per MMBTU. If I look at this and I add on, if I say, hey, in Q3 they produced about 10, just a tad over 10 MTPA, but they think peak production capacity should be 12.4. If I add on 2 more incremental MTPA and I put that at a margin of $2.50, again, that does increase the amount of, sorry, this is sort of, I introduced this concept, I'll talk about just for a moment. This is sort of net margin. I'm calling this net margin as like, this is the equivalent of what they would get if this was an SPA contract. So that's like Henry Hub plus 150% plus this number here, which is 250 for the chart that I have. So you add that in, obviously they get more revenue coming in. Their feed gas cost is higher. Their operating expenses their cost of sales above the feed gas is also higher because they have that additional incremental gas they need to power the facility. But then their operating expense and maintenance costs, I did not increase. The reason why, we've seen this with some of the ramp up in the Plaquemines facility where there's not a direct relationship between their operating expense and their maintenance costs versus the actual amount of production at the facility. So I think this makes sense to keep the same. And then of course their G&A and their interest expense don't change based on their getting to that peak production capacity. Hi there, Essence of Bitcoin. Thanks for hopping on the stream today. And so anyways, for this waterfall model with the incremental to MTPA, that actually significantly increases their quarterly cash flow to 153, almost $154 million per year. And that's just because that $2.50 spread is basically pure profit for them on that incremental, 2 MTPA. And that would be roughly a 20% increase in their production capacity if they are able to go from, I think it was 10.2 that they did in Q3, sort of at an annualized rate up to that 12.4. So anyways, that is sort of what things look like for the Calcasieu project. I have a similar chart for the Plaquemines. I'm not going to go line item by line item, but the point here is using actual 2025 Q3 numbers. They brought in, as I calculate it, about $1.3 billion in cash flow from the Plaquemines project. And, basically that's because as of right now, they were able to sell these at very high spreads. I think if we go back to this chart here, you can see as of right now, the spread between TTF and Henry Hub is way high. It's going to decrease, but as of right now, Venture Global, is able to capitalize on that spread. Hi, Ricardo. Ricardo Flores says, hello, everyone. Was watching Matt, and he mentioned you were live right now about VG. Oh, I didn't know Matt was live. I hate to conflict with other people, but personally, I don't have a lot of time to stream. With my family, it's hard to find the actual time to be live here for, more than 10, 15 minutes at a time without some interruption. And so when I'm able to do it, I just got to do it. Matt's great. Really appreciate him calling me out. If none of you, if any of you don't already follow Matt, which you probably do because he's way bigger than me. His handle is real Matt Money on Twitter, or just Matt Money on YouTube. He's a great follow. Probably my favorite YouTuber, to be honest. Um, just a genuine and real guy. Anyway, so getting back to the material here for the Plaquemines project, I do think if they can get you know, incremental production capacity, I think there's still a little bit left where I believe they produced at 18.4 MTPA, and so they can get that much higher up to that, sort of 27.2 MTPA, at least that they're currently authorized to do. That significantly increases things. And if I make this, sorry, I had $2, make it $2.50 for the incremental margin here. That would bump this up from, sorry, I'm actually using 250 is probably a bad number if I'm looking at sort of versus Q3 numbers, because that their actual realized dollar per MBTU was somewhere around at $5. Sorry, not annuals, but $5.71 per MMBTU in terms of the actual cash flow, because the spreads are so high right now, and those are going to compress, right? And so it's almost nonsensical for me to say to compare against Q3 numbers using a $2.50 margin. But let me flip over and say, once they get down to commercial operations date, and which I think is intended to happen. Oh, let me look that up. Sorry, I think I should have this real quick. Q4 of this year for phase one, and then mid of 2027 for phase two. And so by mid of 2027, the majority of the production that they're going to have at the Plaquemines facility is not going to be under these, what is the current market pricing for TTF and Henry Hub. The actual 19.7 MTPA from the facility is going to kick in and be sold under these long-term sales and purchase agreements. If I assume a fixed liquefaction fee of $1.95, then that really does compress their cash flows from those volumes, right? Because instead of getting the current spread, which as of today, is like $5, they're going to be getting, again, just this $1.95 spread. So that's a lot lower profit margin. But on the flip side, again, they have that margin guaranteed for the next, I think, generally 20 years under their sales and purchase agreements. Yeah, I think all of them are actually 20 years for the Plaquemines facility. And so that's why they signed it with those lower fees. That does leave open the additional, what's that, 7.5 MTPA of production, 7.8 maybe, or 7.6, I don't know. Whatever it is, 27.2 minus 19.7. But that incremental amount of production, they will sell at whatever the prevailing market price is. And so I made this chart here to show what do they get if they only sold their contracted volumes. And so this is basically the scenario. This is the bear case, right? This is the case where if we go back to that Goldman Sachs forecast, and they say if it is unprofitable to actually buy Henry Hub and liquefy it and ship it out to Europe or to Asia, because Henry Hub prices are basically at the same price as what TTF gas is and JKF LNG is, then of course you can't pay to liquefy it. And in that case, Venture Global will only be getting the profits from their fixed long-term sales and the fixed fees from their long-term sales and purchase agreements. And if I look at that, that would end up being on this 19.7 MTPA that they have agreements signed for, $214 million per year, roughly 215, I guess, if you round it, of cash flows from the Plaquemines facility. So that is after paying the interest that they have for the facility, as I calculate it right now after that additional issuance in December. So that, I think, is good to know, right? That even in the case that, going back to this where there's the spread is minimal or even negative, Venture Global will still make profit from the Plaquemines facility. They make a tiny bit from the Calcasieu facility. They make a little bit more from the Plaquemines facility just because it's larger. But the real money is all those other months of all those other years when there actually is a spread. And if we assume that $2.50 spread per MMBTU on average, again, that's going to be higher some months and lower some months. But if we looked at a $2.50 average, and we look at their production as being 27.2 MTPA peak, which again doesn't include in the recent filing to increase that ceiling up to 35 MTPA, that increases their cash flow from the facility on a quarterly basis from $215 million per year to $450 million per year. And so that I think is, again, almost, is that doubling? That is doubling their cash flow from that uncontracted capacity that they have. So again, you have your base case, your bear case, that they're still profitable, even if the spread is 0 or negative. And then if the spread is even $2.50, they're going to make double that. And again, as we look through at the next 3 years, the spreads are higher than $2.50. 2026 much higher. 2027, in the above $3 at least. So at least 30% higher than that 250 spread. Now, if we go and we look at Venture Global overall, there are some additional expenses, right? They do have there's some additional revenue and some additional expenses. So let me walk through this very, very briefly. If we look at, and I also flipped the charts from quarterly to annual because it's sort of looking at a larger view of the company, looking at an annual view here. I looked at the cash flows from the Calcasieu Pass facility and the Plaquemines facility. If we only looked at their contracted volumes, right? So that's what this chart here is. Only their contracted volumes, only assuming the SPA fees that are pretty low, right? I think, and then so I add those in. I also added in estimated cash flow from their delivery and shipping business, and that's I'm not going to go through the details here, but they do actually make a decent amount of money from that. Now, on the expenses side, they also have to pay corporate G&A. Then they also have to pay interest expense on all the rest of their debt that is issued at the actual Venture Global level, because we've already accounted for the debt at the Calcasieu Pass level here, at the Plaquemines level here, at the project level debt. But then Venture Global itself has a number of additional outstanding notes and bonds that they have to pay interest expense on. So you can see here, if we look at their contracted volumes, they are barely profitable if they never sold a single cargo over and above what is signed under their sales and purchase agreements that they have. And I do want to make one huge note here. I did exclude their CP2 loan. So they do have this additional loan that they have. Let me see. I have their 10Q. I can pull it up and take a look at here. They do have this CP2 construction term loan and CP2 holdings, equity bridge loan facilities. I think is what the EBL stands for. So they do have like $3 billion of debt that they borrowed against the CP2 facility. And I'm excluding it here only to sort of give an apples to apples comparison. I mean, obviously this is real debt that they've issued, that is real interest that they have to pay. But I excluded it to sort of give you a picture of if they hadn't done that and we just looked at the company as it is with the Calcasieu Pass facility and the Plaquemines facility, they have matched up their debt and their long-term sales and purchase agreements to where they're basically break even. And so then all the upside in the company comes from either future expansions, of course, but also all those uncontracted cargoes. And so that's why the future LNG prices matter a lot to Venture Global in terms of what is the return going to be for investors. And again, as we look through the most firm prices that we have over the next 2 or 3 years, at least the 2 years, those are all positive. And so that is all going to be sort of incremental profit and cash flow on top of this. I'm going to pause real quick. I saw there's one more comment. Essence of Bitcoin says, looking at how volatile the prices of natural gas are, where they fluctuate almost 30-40% within a month and are extremely sensitive to weather, I wonder if these Goldman Sachs models are even reliable. Or if I may rephrase, the Goldman Sachs models are as reliable as weather forecasts. 100%. Well, so I won't say 100%, right? Because there is a little bit that they can look at where it's not just the weather. So that is on the demand side, right? Where there's so much variance on the demand side in terms of the weather. Totally right on that part. And the issue is in the short term, right? The production can't ramp up quickly, and so like it's highly leveraged. Where if things are all balanced, right, it's at some sort of equilibrium point in terms of the price. But because of the weather, in the very very short term, right, they can't actually produce more gas, and so they have to, they can't even transport more gas necessarily. Depending on where you're at, maybe the constraint is not even the gas production. Maybe it's a transport through pipelines. All along the way, it's a there are constraints, and so gas prices are going to fluctuate pretty wildly because of those kinds of, whatever the constraint, whatever the bottleneck is, might drive the swings in the very very short term. The Goldman Sachs thing might be. I'm playing devil's advocate here to try to say that I'm not going to totally throw out the Goldman Sachs model, even though yeah I'm a little skeptical of the Goldman Sachs model myself, and I'll get to sort of I'll just talk it through right now. Um, but I think the Goldman Sachs model is also looking at how much new supply is coming online, right? Because you could look at confidence intervals, let's say for your 90% confidence interval for what the weather is going to do. And of course, there might be outliers. If you had the coldest winter ever on record, or the warmest winter ever on record, those sorts of things are going to uh, make the forecast in terms of demand, get thrown out the window because you're way an outlier on one side or the other. But they can also look at and say, well, we're 90% certain. If we look at historical weather patterns, it's going to be between here and here in terms of the demand, and then they can look at the supply and they say, well, the supply is going up and up and up and up, and so we think sooner or later, because the demand even at the high levels is only here, and even if we look at incremental demand of price drops, there's only so much incremental demand, but the supply is still projected to go up and up and up. Then that's kind of where they're looking at this, and they're saying, well, but we think it's really gonna collapse the prices just because there's gonna be so much supply, competition is going to kick in, and there's more LNG, more gas out there looking for buyers than what there really are buyers that need the gas. And so I agree with part of your point, which is there's so much variance, but I think the fluctuations, if you look at it, 30-40% within a month are for like the short-term natural gas prices. I don't think we see the pricing a month or 2 months out. Sorry, not a month, a year or 2 years out, varying quite that much. But on the flip side, I also think Goldman Sachs, and again, I think there's let me give this caveat that this is the public version, right? This is the redacted version of the original report. I am guessing there is a deeper. I'm guessing there is a deeper and more detailed report that they have published to paying customers, right? This is what you and I, sorry, maybe I won't lump you in with me, but me as a cheap person who does not pay Goldman Sachs for their research, this is what they give to us, to me. And so maybe they do have this level of, analysis done there. I really don't know what all of their rationale is behind this. All I know is kind of what they've put out in public. But I am also a little bit skeptical that as gas prices go down, that we wouldn't see incremental demand show up somewhere globally. Energy is a pretty useful commodity, especially nowadays with let's say data centers. And I don't want to talk about data centers too much. I do work at a large company in the data center division, so I can't say a whole lot about that. But yeah, Essence of Bitcoin says you're correct. I see your point. Also says I am poor man. You can definitely club me in. Yeah. But just to say that there wouldn't be additional factors that might people might look ahead at that and say, hey, I could actually use some more energy. That I think is a pretty again, things do tend to balance themselves out. It would be barring some sort of a like 2020 pandemic level event where of course energy prices went negative, barring something like that, it's hard for me to see where the spread would actually go to zero. But again, I'm not as smart as people at Goldman, so we'll just have to wait and see, I guess. And sorry, I also got another question. Blue Mountain 209 says, what is the end goal for you for the stock? Grow and sell or hold these for sweet dividends? For me, for most of the stocks that I hold, and this is just my personal style, I basically hold I plan to hold for a very long time. Um, it's an adjacent company. It's not the focus today, but it's another U.S. LNG exporter next decade. I think I hold shares of that that I purchased in 2018. I still am adding more shares today. I've got a number of other companies that I've held for years and years and years. I really most companies I'm willing to take a very long-term view on. I do my analysis for myself usually on where do I think this company will be in 10 years, and um, so for me, I guess my personal goal for this is to right now keep buying shares. I don't have as many as I want to have, not even close. Um, at least with the prices where they are right now. Again, price makes a big difference in terms of how many more shares I want to buy, but uh, I intend to hold this for a very long time, um, up until the point. I reserve the right to sell if I think the company hits basically where I think it should be in 10 years. And I have that view for some other companies. Um, anyways, that's sort of my own. It's just answering that question for myself. One more question here before I go on. Mark MMHH3221 says they have a large debt right now, don't they? Yes, they do. So Venture Global, and I have this in my this gets back to where I was going on my content here, the actual prepared stuff. They do have a lot of debt. And as I mentioned right now, if we look at only their contracted volumes and the profits they would bring in from those, the interest that they pay on their current debt would basically wipe out all of the gross profit that they would have, and so the actual net income or free cash flow would be basically negligible if they only sold what they currently have contracted. Now, that is obviously not the state of the company. They have a lot of incremental capacity. They have 30% of their LNG as incremental capacity. And so if we include that in and we put that in at a $2.50 spread, this instead is what the waterfall chart looks like, meaning now all of a sudden they're making a lot more money, and that interest expense didn't change, but it is relatively smaller, and so they do have free cash flow of about 1.2 to 1.4 billion dollars. And I say that range because I also included in here some incremental reduced interest costs from refinancing. So I mentioned earlier in this video, if you didn't catch the beginning of the stream, Venture Global did get some of their bonds sort of at the Plaquemines project re-rated, and I assume they're able to sooner or later refinance the debt that they're currently paying, between 6.5% to 7.75% down to about 5.5%, maybe even slightly better. And that will reduce their interest expense even if their debt levels stay the same. And so that does bring in, or it reduces their expenses by an additional $136 million per year. And so that's right here. It shows up as a green. It really should be a reduction in the red. The net result is the same, where their ending sort of cash flow to the firm increases. And so if we account for peak production at 27.2 MTPA, which the Plaquemines facility basically is already at, give that a $2.50 fee equivalent, as if it were an SPA contract, that gets us to, as I said, about $1.4 billion in terms of, cash flow to Venture Global. And once again, I'll make the note that that excludes their current CP2 loan, because I'm going to have a separate chart in just a moment I'll go through that does include the full CP2 facility. I just think it's a bit, it's not really an apples-to-apples comparison to include in the debt that they've sort of pulled forward for CP2 without also including forward what the revenues are going to be like for that facility in terms of actually trying to value the company. So if we looked at the valuation of the company for this amount of cash flow, if I use a 10% discount rate, if I value those cash flows as a perpetuity, and I'm not going to go into details here, but this is with that discount rate would give you roughly, I guess not roughly, exactly a sort of 10 price to free cash flow. Assume 2.7 billion shares outstanding. That gets you to intrinsic value per share of the company as $5.11, which obviously is below the current price, and obviously I'm bullish on the company, so why am I looking at this if it's only $5.11? Well, so there's a number of bullish factors that are not factored in here. The most notable of which is that they are going to build a CP2 facility. They already have almost all of the, like 90%, more than 90%, I believe, of the nameplate production of that facility already factored in, or sorry, already signed under long-term sales and purchase agreements. And so if we add in the CP2 facility, also add in the interest expense from that facility and new debt that they're going to have to take on, that now we're looking at more like 2.8 to 2.9 billion dollars per year in terms of cash flow to the firm, right? And so this is assuming that they are able to produce peak at Plaquemines and CP2 27.2 MTPA, and that they're able to get the equivalent of a $2.50 sort of fixed fee spread on that. And that is, leads us to an intrinsic value per share of roughly $10.58 at production for CP2, which again, they're not quite there today. So this is sort of a future valuation. And so, maybe you could look at that and say you discount that back to today, and, maybe $7 to $8 is a fair price if you only ever include this. Now, there are a number of additional bullish factors that are not built into this, not the least of which I can show you right now and say that is, what if they end up producing more than 27.2, right? That was, I talked about at the beginning, that they have filed to actually increase their authorization for these facilities from 27.2 up to 35, and that applies to both facilities. So if I change this number here from 27.2, let's say they do get that full 35, that means the intrinsic value per share at full production for both those facilities, which again would be, I think, end of 2027, I believe, somewhere around that vicinity, would be $18 at the end of 2027. Intrinsic value per share. This also doesn't account for any refinancing of the debt from the Venture Global level, which again, I think they're going to be able to do this once the Plaquemines up and running, and they can show, hey, we've got enough cash flow coming in right now to cover this debt. The CP2 facility is going to bring in even more, and they're able to also directly pay down some of that debt because, I'm using $2.50 for their fee equivalent on uncontracted cargoes, but as I showed, in the next couple of years, they're making, basically almost double that in 2026, 30% higher in 2027. And that's money that they can take immediately and pay down some of that debt. But if let's say, do the quick math, and let's say they were able to save an incremental, I think I did a little bit of, I have some of my notes right here. So if they were able to, where's it? My notes. I got too many notes here. Too many notes. I apologize for not finding this, but I'm not going to go through it. I guess I can't find it. I have too many pages of notes that off screen here. But if they were able to actually refinance some of their Venture Global level debt, that now I think today is around 8 to 9 to even 10%, somewhere in that vicinity. If they were able to reduce that, and they've got, I just go to their balance sheet here and take a look. Venture Global debt, they've got, eyeballing that, it's what's that, close to $10 billion in debt at, between 8 to 9.875%. If they were able to refinance all that down at, 6.5%, 6%, somewhere in that vicinity, if they were able to get the Venture Global, the company itself, that amount of savings could be pretty significant. I'm just going to do really, really quickly, if it was $10 billion and they saved, even 2 percentage points, they'd be saving at $200 million per year. If you even add that in, these are quarterly numbers right here. So if I add it on, what's that, 118, that's an additional incremental 50 cents per share value just from being able to do that, and I think they could even, it could be more than that. They could save 3 percentage points, but the point is they've got that, and then they've got they got expansions at these facilities, right? So as long as there remains a positive spread on LNG, they're going to expand to the Plaquemines. I think they have bolt-on expansions potential at CP2 and at the Calcasieu Pass facility, all of which are going to be, sort of low-cost facilities because they're expanding at an existing facility that they already have. Not to mention the CP3 and Delta sites that they have that they could build in the future. So the whole point here is this intrinsic value calculation that I have. I'm going to undo some of the changes I made here just to get back to kind of like a baseline. This intrinsic value calculation that includes basically just CP2 is saying, hey, right now they are, they're roughly fairly valued with a CP2 facility up and running right at that point. But there are so many incremental factors that I think that could happen for this company that are very plausible. That just looking at what is the value from the facilities they have and ignoring all the expansions is undervaluing the company. And so it's up to you in terms of how much potential would you give it? Would you give the company for all of those? But I think it should be more than this. So, all right, that was a lot. Again, this is kind of like the bottom line of sort of everything I had. That is the end of all of the prepared content I have. I'm going to go through and, read the comments. But that's all of it right now. And the rest of this, after I get through the comments, I'm going to hop off for today. I appreciate everybody who's already been here. If you want to hop off now, thank you very much for watching. So a couple comments I see. Mark MMHH3221 said, I would rather see them suspend the dividend and use that to pay down the debt. Yeah, I don't think their dividend is actually, it's pretty small, right? I could actually just look at their cash flows here and see how big is this. If I go through, so their dividend, payments of dividends, and so if we look at 9 months ended September 30th, 2025, so let me divide this by 3. So in one quarter, if I want to compare this, 423 divided by 3 would be $140 million. And yeah, so $140 million versus their, if we look at their, let's see, what was their operating cash flow? $4.4 billion. I mean, it's not huge. I don't disagree with you. I do think because they are still in growth mode, I actually agree with you. My point is, I guess it's small. My guess, I have two speculations on this. I think, number one, they just recently started paying this dividend, if I recall from reading their S1. They were already paying it while they were private. And I wonder if Venture Global, I wonder if they actually didn't plan on bringing the company private, but wanted to start sort of paying themselves back some money. That's a bit of my speculation as to why there might be a dividend. The other bit here is, and this is a long-term view, these guys might also be thinking in terms of long-term, maybe we want to be considered on some of these, dividend-paying lists where they different companies or different institutions will list out and say these companies have been paying for 5 years consistently, 10 years consistently, 25 years consistently, and starting right now, even with a small dividend, does sort of get them, it starts to build that track record. I actually agree with you from, again, from a capital allocation standpoint, from a mathematical standpoint, it does make sense, I think, for them to not pay a dividend and to pay down the debt, but there's kind of some small qualitative benefits that they get for being a dividend-paying company. I also think that opens it up to certain funds and ETFs to invest in Venture Global that otherwise wouldn't, just because they, sort of that's a checkbox that needs to be checked to actually say, does this company pay a dividend? But I think you're right from a capital allocation standpoint. While they're still in growth mode, it's definitely better for them to, use the cash for growth, right? And I think that alternatively, when you say pay down the debt, like obviously paying down debt, you may not view that as growth, but like they wouldn't have had to take on the debt had they just taken that cash and said paid it down, for the growth itself, for the capital needed, the capex. All right, and then Wing Thamo, sorry if I mispronounced that, says, I think the time is right for a VG and next deep dive with your boy Matt Money. I would love to do that. I'll just be honest. I've never reached out to him. He's never reached out to me in terms of actually being on their channel. I would be totally up for it, with the one caveat that I have 4 kids and a job, and I love doing stock analysis and YouTube and especially Twitter recently. Twitter's easier for me to fit in, 5 minutes here, 10 minutes there. It's hard for me to find the time and to coordinate with other people to do this. And so that's just like, that's probably, my life is pretty busy and hard to coordinate, but I would love to hop on with Matt at some point and do that, or anybody else. I think there's so many great financial YouTubers out there. Matt is, obviously awesome. So I would love to do that if the opportunity presented itself. But it's been, again, just on me, I haven't reached out for that just because my personal life is so busy that it's hard for me even to find the time to hop on here on my own channel when I can click the button exactly when it is most convenient for me, even to get on here for an hour. I think my last video was like 3 or 4 weeks ago. That's basically it. Chris Redfield 4291 says, what about their arbitration decisions? Do you see that as a catalyst this year? So that's a good question, and that's actually a really good caveat I meant to mention earlier. So if anybody hopped off, I hope they were already aware of this. I did not include that anywhere in here in my valuation for the company. And I really should have. I usually just basically say that's on you as your own personal investor to say, what handicap do you want to give in terms of valuation because of their arbitration. So personally, again, I really have no idea. It's hard for me to understand why legally things are even in the state that they're in, given that, it seems like the outcomes have been different. And I know people have basically said they've implied that the contracts were different. I'm actually not sure that the contracts were really that different. Maybe they were. I don't know. Again, this is so deep into it, and I don't think even their contracts, I don't think there's enough that's publicly disclosed. So I don't know that we really have any real basis for having an informed opinion on that. It's a little hard for me to see that the damages are going to be. Sorry. Let me go through in a couple things. I talked about this in the past, but so I'll try to keep it brief. It's hard for me to see where any of the arbitration decisions could be, sort of company ending. Especially because worst case scenario, let's say there was some ridiculously large judgment that came down as a negative towards Venture Global. I believe the liability is limited to only the Calcasieu Pass portion of the company. So if they really had to, I believe they could declare bankruptcy on that facility, let that go through its proceedings, and I don't know what would happen of it. Maybe they'd have to divest or whatever with nothing coming back to the overall company. But I think they would still retain the Plaquemines project, the CP2 project, and all the rest of it, which, if we're being honest, most of their profit does come from the Plaquemines project. Again, they do get some from Calcasieu Pass, but if we look back at this, waterfall model where this one is looking, only at the first 2 facilities, excluding CP2, you can see the green bars here for the Plaquemines are much higher than the green bar here for the Calcasieu Pass project. So it would certainly not kill the company, and it wouldn't even be, they'd have a 20, 30, 40% down, but then I think they'd probably continue growing past that. And especially if the market is really valuing this as CP2 and Plaquemines, now we look at, sort of this waterfall model. Well, the Calcasieu project is really a much smaller portion versus the overall company when you include in both those facilities. So maybe that would only even be a 10%, 20%, reduction in their valuation. Again, I'm not going to predict what the stock would do. That'd be a pretty nasty headline. But I think if we're being rational in terms of the actual cash flows to the company, it would not be the end of the world, even for equity returns. So Mark says once the debt is paid off, they will do a killer dividend, 100%. Yeah, I mean, just look at it, that's a lot of cash flow right now, right? I think they were, as we said, they're paying $140 million per quarter. And so I think if we look at this annually, once they get to this point, they'll have $1.7 billion per year in interest expense. When they pay off a lot of that frees up a bunch of cash. Wingthamo says, at current prices and considering risk, potential upside, etc., between Next and VG, which we consider better buy right now? Thanks a lot for the content. I don't want to give you financial advice. For me personally, I do think at current levels, next decade is, when I'm again looking out a decade, 5 plus year, right, more than 5 years, I do think next decade has fallen quite a bit more. When next decade was trading more, a bit higher in the, closer to $7 as well, where the stock prices were similar. Obviously, the market caps are different. Um, it's a much harder decision between the two. But I think both are good companies. I am adding to both, to be honest. If you're looking just me personally, but if I've added, I think I've added about equally, although I have a larger existing position in next decade because I've purchased shares of that for a number of years, and Venture Global obviously hasn't been around for that long. So that's just my own personal opinion. All right. I am, I think, going to hop off now. That is the end of the comments. It is an hour and 10 minutes in. I've covered everything that I plan to cover today. I appreciate everybody who helped on today, and I appreciate you all watching. Hope you enjoyed it, and feel free to, follow up, ask me questions, comments in the comments on YouTube or on Twitter. On Twitter, I'm just at Dustin's Dollars, or X, I guess, as it's called nowadays. So, anyways, that is it for today. Thank you for watching, and have a good one.